ladies and gentlemen, this is your ticker guy coming at you from wonderful Niceville, Florida. I am producing my usual quarterly Fed Z1 report here. We do a ticker on this every quarter. You can find it at market-ticker.org. But for those of you that prefer a visual look at this and somebody to narrate it for you, I thought I'd do it in video form as well. This should be required viewing for everyone in America. You heard only a tiny little piece of it yesterday, the 9th, when the Fed Z1 was released, and that was that everybody should be incredibly happy because stock prices are at all-time highs, and therefore everyone's wealth effect is wonderful. This is not all there is to say about the Fed Z1. Let's start with the basics. The amount of debt in the system compared against the growth in the economy. This is the GDP, that is gross domestic product, all products and services produced in the United States. And this is the total amount of debt in the economy. You can see that we peaked out just before the crash in 2008 at about 375%. We have then, since that time, declined in the latter part of 2011 to about 350, and we sit there today. There has been no meaningful change over the last 2 years. So for those who think that the economy is improving, why isn't this ratio coming down? The answer is it is not coming down because there's no meaningful improvement. We're just kind of going sideways. And it is this bubble-like expansion that drove the incredible escalation in equity prices here. And then in the 2003 through 2007 timeframe, it was all credit market growth as opposed to economic growth that drove asset prices, specifically house prices, higher. We all know what happened with home prices, right, from 03 to 06. Okay, so when we break this down, the Z1 gives us a very convenient way to look at different sectors of the economy and see where credit growth and contraction is occurring. And you can see that the main bubble in the credit markets from 2003 to 2007 came from two places. One was consumer credit, that is mortgages. And the second big bubble was here in financial credit. And this has been going on for a long time, going all the way back to 1980. And that is banks lending money to each other, so to speak. And they're printing up credit. This is credit default swaps. It's all the crazy financial instruments that they do. During the crash, that contracted precipitously. You can see that we went from this large area here to a considerably smaller one. And who picked up the slack? The federal government, largely. But what has started happening here recently, just in the last couple of years, is that businesses have started to borrow. And this is often seen as a sign of an improving economy. I want to point a few things out to people on this, though, later on. But keep this in mind here, because this expansion here, as you can see, there is no meaningful expansion in consumer borrowing, but there is in business borrowing. And this can be one of two things. It can either be okay if it is to finance production, and not so good if it's to finance other things like speculation, for example. And as you can see, state and local governments, as well as the rest of the world, doesn't seem to be expanding very much. So all the growth in credit is coming in two places. Business expansion, the last couple of years, and from the time of the crash in 2008 onward in the federal government. So what has happened really in the economy in the last quarter? Well, remember, we heard recently that GDP was growing much better than expected. But was it really? In order to look at GDP in real terms, you have to subtract out credit growth. And the reason for that is that when I borrow a dollar and immediately spend it, that shows up in GDP. But this does not tell me whether or not the economy is actually producing more absent that growth in credit. The reason for that's quite simple. The number of dollars goes up in the economy, then what each dollar buys goes down. So as we issue more credit, each dollar buys less. And in terms of production, say, for example, per hour, or production per gallon of gasoline, or barrel of oil, or ton of coal, it would not change. It does in nominal terms, and of course, the government likes to use what's called the deflator to get what they consider to be real GDP. This is a misnomer. You need to look at the entire credit and money supply in order to do that. And as you can see here, this last quarter, it was absolutely flat. So what this means is that despite the so-called better GDP growth in the third quarter, the truth is there was none whatsoever because credit grew almost exactly as fast as GDP did. So there was no net change, and in fact, it's negative. So we, other than during the crash, when we had a little spike upward here, we've been in a 30-year trend where we've actually been producing less per unit of output. And this is very important because this goes to your prosperity. If you're wondering why you're getting behind so much and you continue to lose ground as a consumer, as an average person in America, this is the reason. The only way this stops is when credit expansion is stopped, unless it is backed by some kind of tangible asset. And we're seeing that that's not the case. All this Fed Reserve, QE, and federal government deficits are what produces this condition. By the way, if you're wondering how bad it can get, just before the crash in 2007, we were putting $7 of credit into the economy for every dollar of output we were adding. So it can get a lot worse than it is now, obviously. All right. We can distill this down into its impact on you. And in fact, we should, because what matters is your income, right? So we're going to look at this a different way. I took the BEA's tables here. This is personal income from all sources, not just wages, but also capital gains, dividends, interest income, all sources, rental. And we take that growth rate, which is here, charted, and we look at the monetary inflation, that is total money and credit expansion in the economy. Since all money in our economy is debt, all modern economies work this way. We can just compare these two and see where you stand. The bottom line is that at an annualized basis, as of this last quarter, you're losing about 4% a year. Now, that's a very serious problem, ladies and gentlemen, because 4% compounded over 10 years is not 40%. It's almost 50%. So what this means is that over 10 years' time at the current rate, you're going to lose about half of the buying power that your income gets you. Your nominal salary, the amount of money you receive, and by the way, this income does include government transfer payments. That is part of this computation. Goes up in nominal terms by about 4% a year. However, what it buys goes down by about 4% a year. So what we're seeing here is not, and that does not sum to zero. This is the difference. We are seeing approximately a little bit less than 3% in terms of income growth, but approximately 8% growth in credit expansion at the present time. This is down a little bit from the last quarter, but as you can see, from the time of about the first quarter of 2011, now approximately 2 years forward, you've been badly losing ground again to credit expansion. So if you're wondering why things seem to be more expensive and your paycheck is going less and less far than it used to, here's your answer. This, again, deficit spending and quantitative easing, folks. That's the cause of it right there. Finally, I want to talk about this chart because this is probably the most important one of all in relationship to what you're being told in mainstream media. We keep hearing people talk about how stock market valuations are reasonable and that prices are not particularly high compared against things like, for example, forward price earnings multiples and things like this. That's the wrong metric to use. What you need to be asking yourself is not just what you think you're going to get predicated upon future earnings. Of course, the problem is that we don't know what the future is. So if you try to use future earnings as a metric for what you should pay for a stock, what you're doing is saying that you want to believe in unicorns because it has been conclusively proven over time that earnings estimates are almost always wrong. Now, they could be wrong in a low direction, but they can also be wrong in the high direction, in which case you have grossly overpaid. What's much more consistent is the relationship between stock prices and tangible assets less credit. And that's very important to look at because we can judge the bubbleiciousness of a market, that is, how far ahead of things we happen to be, and whether or not we are actually trading at some semblance of reasonable value predicated upon those things. We can also find times when markets are extremely cheap based on that as well. And here's where we have a problem. This is our tangible assets that corporations own. This is according to them on their own balance sheets, okay? So we're being pretty generous here. After all, people do sometimes misstate their asset valuations by a wee little bit. We've seen that repeatedly, haven't we? However, liabilities, that is, how much you actually owe people, is always known to the penny. Nobody ever lies about that because the guy on the other end is who you owe the money to, and he always insists on getting paid. So as a result, this credit number is considered to be accurate. And then this is equity value. And you can see that in 2000, we had the peak here just before everything crashed. 2007, we had a higher peak, and then, of course, we crashed. And now we're way up here. Valuations are at a record high. And people say that, but they're not very high compared against other measurements. Well, yes, they are. They are higher compared against asset valuations than they were in 2007, not on a ratio basis in 2000. All right. However, we have to look at what's happened with borrowing here. As you see, as assets have gone up, so has borrowing. So in order to get a clean picture of what's going on, we have to subtract out what you owe from what you own. And when we do that, we find a problem, because on a ratio basis, the 2007 crash happened from a higher point. In other words, valuations were more reasonable on a credit-adjusted asset basis in 2007, before they crashed, than they were in 2000. Here, the ratio was about 4.5, 4.5. Unfortunately, today, it's about 4.8. It's actually higher today, adjusted for credit, than it was in 2000, just before the crash. This does not mean it cannot go further. It does mean that you have to be very careful to look at valuations in the stock market today and say that they're reasonable based upon supposed earnings estimates, because if I use debt to buy back stock or to pay dividends as opposed to expanding the business, I temporarily make my earnings look better, and therefore my price goes up. But what's happened is I've added to the liabilities on the balance sheet, and I must subtract off from my assets those liabilities to get a true picture of what the balance sheet looks like. And when you do that, you see that on a credit-adjusted basis, in other words, taking debt back out, we are only back to about where we were in 2005 in terms of balance sheet strength. Unfortunately, we are approximately 40% higher in stock prices, or about where we were in 2009-ish, as we came out of the hole in that September-October timeframe around here. This, by the way, was when the S&P 500 was trading at about 900 to 1,000, right in that general area, 900,000, 1,100, in that general range. Today, the S&P 500 is trading 18. So it is entirely possible that we could see a 40% drawdown to here, okay? And if we did see that 40% drawdown in the stock market, it would only bring us back to valuations that we saw on an honest basis in about 2005. In other words, just before the big blow-off in the market and it blew up. By any stretch of the imagination you care to use, folks, the stock market is ridiculously overvalued as it stands today. That doesn't mean it can't become more ridiculous, but this does put a point on valuations of equities compared to the actual balance sheet positions of companies that you're not going to see in the mainstream media, even though the data is right under their nose. Good luck.